Thank you, and welcome to yet another episode of Economics in Business. I'm your host, barret.g.kupelian, and I'm joined here by Andy Haldane. Andy, welcome.
Thank you, Barret.
So I thought for today we should cover sort of three main themes and topics. The first one is around the unexpected resilience of the global economy in the face of successive shocks. And God knows we've had a few big shocks in the past few years. The second one is quite interesting one, which is based on a question I got from a client about a week ago, which was about what do we think are going to be the main mega trends that will define the global economy for the next 10 to 15 years. And then finally, I think throughout these two sort of themes, I think what we'll draw out is potentially some lessons that we could extrapolate for the UK government as well. So with that, maybe we should start off with the first one, which is about the unexpected resilience of the economy. And I think the genesis of this was a piece of thought leadership we've done on energy, which we presented to some of our clients. About what the UK energy system could look like and should look like in the next few years, and how it's become a real lever of economic competitiveness. And one of the issues we covered was around resilience, which we'll get to in a bit. But then the other point I think we talked about was about our three scenarios for Iran.
Yeah.
So now we're in a situation where we've got a framework for an agreement. And if our careful viewers and listeners remember from the previous podcast, we talked about three scenarios. The first one was around a sort of an assumption around an agreement being sort of instilled this year, and for the flows out of the Strait of Hormuz recovering, but not really recovering to pre-war flows. And then scenario 2 and 3 were even more sort of adverse scenarios. And it seems and it appears, even though there are some bumps along the way, that first scenario of a framework of an agreement being in place and flows from the Strait gradually building up seems to be the one that's closest to what we're experiencing. And if our viewers and listeners remember, that was the one that had the least economic impact, but it did still have an adverse economic impact in terms of GDP and inflation compared to pre-war forecasts. So that seems to be the situation we're in. Of course, the situation is quite unfluid and difficult to predict, particularly in the view of the fact that there isn't an end state, at least not yet. But then the other point we talked about is how resilient the global economy has been. And I think you had a few pointy thoughts around that. Do you want to articulate some of those thoughts?
Yeah, happy to, Barret. And I mean, you're right that since we did the previous of these podcasts, when all three of the scenarios you mentioned were probably equal probability, I'd say, it's been good news overall for the world economy that we look to be converging on scenario 1, which is essentially the normalization scenario. The best case scenario, if you like. And that's good news. And that means if indeed it comes to pass, and of course it's still an uneasy truce, we'll see a bump in inflation, but it'll be a modestly sized bump. We'll see a trough in growth relative to expectations, but a relatively shallow trough. And that's probably the best case we could have hoped for, a month or so ago, I'd say. But it's against a backcloth where, given the scale of shock we saw, the response already from global financial markets and even from the economy had been surprisingly modest, right? We saw oil prices pick up, but given the scale of shock, this is the biggest shock in terms of barrels per day lost we've ever seen. But on a graph, the pickup in prices is relatively modest. This was a significant shock that doesn't appear to have done much to dent growth in the economy. Certainly it's done nothing to dent the fortunes of equity markets, which have kept on surging to ever greater high. So this is a story of remarkable resilience or dynamism in both the real economy and in the financial economy, which begs the question why. I'm not sure I've got a perfect answer to the question why. I'm sure you'll have some thoughts as well. I mean, some of it, I think, is that we've learned the lessons from crises past. So after Russia-Ukraine, we did stockpile more oil, and we've been able to draw down those reserves to cushion the impact on oil prices. Facing COVID and then Russia-Ukraine, I think businesses and governments have become more adept at moving around their supply chains globally to circumvent the choke points like the big choke point that was the Strait of Hormuz. And when it comes to financial markets, in some ways, they're taking their rhythm from last year, where despite the shock to trade and Liberation Day, we again saw stock markets riding out that storm and some more, and that's been the pattern this year as well. So I think the positive takeaway from this is of a surprisingly agile set of global supply chains, a surprisingly resilient set of businesses, and a surprisingly exuberant set of financial markets. And for that, we should all count our lucky stars, I think.
Yeah, agreed with those points. And I mean, one of the things I mentioned at that breakfast, if you remember, was that, in the past 6 years, we've had 5 big sort of global shocks to the economy. And I've got them listed out here in case I forget the order. But one of them, the pandemic, the Ukraine shock, the Iran crisis. I think AI is another one which was sort of lurking in the background. Yeah. And finally, Liberation Day. So I think there is something about muscle memory being developed over these successive shocks. And it's interesting for me because, we are business economists here in PwC. So the aggregate economic impact might be relatively muted, but actually the business implications are quite stark. So, in the pandemic, not in the pandemic, but in the Iran crisis, we saw airlines, for example, really struggling, canceling flights, rerouting, and so on and so forth. Energy-intensive industries in general were either stockpiling or using alternative sources of energy. And so it was quite interesting on how, if you look at the economic numbers, you'd go, maybe not a big shock in itself, but actually the underlying machinery of the global economy was quite adaptive, which was quite impressive to see and refreshing to see. And we do know that these type of particularly supply side shocks seem to be occurring at a much more frequent basis, yes. At least if you use the past few years as an experience. So it's good we're developing that muscle memory. But then the other thing I would say is the financial sector, since 2012, I think it was, when the systemic stress test started being implemented in the UK economy. I mean, the resilience that's been built in the financial sector, I think, has been a lesson for some of the big businesses to replicate. Yes. Because you've got stress scenarios, and then you sort of try to translate on what that means to your business, and then find the mechanisms or the big business decisions that would reduce the impact. And I think a bit of that has been happening quite quietly in the background.
Yeah, I think that's a very good point, that after the global financial crisis, there was a big regulatory imperative for the financial sector to get its balance sheet in shape, and that means less leverage and higher cash flow and regular stress testing. But actually, many of those lessons, I think, have read across to the non-financial sector as well, which is why we see them running with lower levels of debt, why we see them running with higher levels of cash flow, why we see them subjecting themselves to scenario analysis, the like of which you carried out. And that's all, I think, just the job for this era. I think we are in an era now of many more of these jarring global supply side shocks.
Yeah, agreed. And the other thing I think that was, again, interesting about the Iran crisis, yet again, it shows how interconnected the global economy is. And there's one aspect which no one really expected, which is the point around the quite abrupt decrease in imports of oil by the Chinese economy, which was quite influential in actually settling the oil markets and actually helping the rest of the world that was quite reliant on oil flows. So it just shows how sometimes interconnectedness does lead to shocks transmitting at a fast pace, but also it does build a degree of resilience, sometimes in unexpected ways as well.
Yeah. No, I think that agility, which you saw on the supply side, let's reroute oil through different, it's been true on the demand side as well in certain countries. And as I say, that muscle memory will hopefully, touching wood, Barrett, serve as well as and when the next nasty comes along. I think it is a question of, as rather than when.
And then just to wrap this up, I think the other thing that was really interesting for me is, we as economists have a certain concept of what competitiveness constitutes. It's around having flexible and educated labor markets, open and transparent economies, good rule of law, sometimes time zones for the UK is quite helpful, predictable regulatory framework. But I think increasingly having access to cheap and reliable energy sources is also becoming something that should not be taken for granted and something that policymakers should be working towards, because that is becoming a key lever of competitiveness in a way that we weren't used to in the past, actually.
Yeah, I mean, quite so. And it's quite interesting just here in the UK, where it's well known that our energy costs are high relative to international competitors, how much energy has been the focus of policy discussions when helping businesses become competitive on international markets. And indeed, if you ask businesses, the various business surveys point towards high energy costs as being one of, if not the most significant barrier to competitiveness here among British businesses.
Yeah. Okay. So that, I think, is a nice segue to the megatrends, which, in my definition, what a megatrend is, it is sort of big or mega trends that are likely to define the global economy and society in the next decade or so. And, irrespective of which sector of the economy you're in or which country you're in, you're not insulated from these changes. And the reason, as I said, for this sort of little segment in the podcast is because I got a question from a client about what we think could be the mega trends that will define the global economy in the next sort of decade. And the reason and the genesis for that was because a few years back as PwC, we put out the 5 main global megatrends we thought would persist in the global economy. But obviously, since then, there's been quite a few big global shocks which have sort of sharpened the minds of policymakers on what these megatrends or the areas of focus could be. So the ones that I have in my back pocket in terms of what I think will persist in the next 10 years, let's say, are the 3 Ds. And that's deglobalization, defense and defense spending, and digitalization. So deglobalization, I think, is around how the global economy is a bit more protectionist now than it was, say, 5-10 years ago. And that means particularly for advanced economies that have a relatively small manufacturing sort of base, I think that means probably a degree of reshoring on critical areas of the economy or what's deemed as critical. And we're seeing sort of governments increasingly putting plans in place to do that. In the UK, for example, we've got an industrial strategy, which covers both services and the goods sector, but it's a point to take. The second one is around defense spending, and I think the NATO sort of summit is ongoing as we're recording this podcast. But in general, I think what we're seeing is a pickup of the security theme, and finally defense spending, particularly across a lot of the advanced economies. And the third one is finally digitalization. So that's all around building a digital infrastructure whilst at the same time keeping abreast of the changes in the digital world with AI, machine learning, and so on and so forth. But the key element, I suppose, underpinning these 3 Ds is the fact that they do require large sums of spending for a relatively long period of time, I would have thought. of which most, but probably not all, will be directly or indirectly driven by governments. And at a time where public finances are stretched, not just here in the UK, but I think across most advanced economies, that poses a bit of a challenge on how you fund these, how you aggressively push these, what choices you make.
Yeah, yeah. Well, I think your 3Ds are right on the money in terms of some of the key drivers, megatrends. I might add 2 more Ds, actually. I'm stretching the fifth one. My fourth and fifth would be demography. Slower moving, less immediate, but when you're looking over horizons of several decades, falling birth rates, which are now in the majority of countries around the world below the replacement rate, which means that down the line we'll see populations falling rather than rising, and certainly aging is going to be a significant medium-term challenge, come opportunity. And the fourth, which is where I'm stretching my D, would be decarbonisation. The net zero agenda. Okay, that perhaps has been less focal over the last couple of years than perhaps over the preceding decade or two, but nonetheless, not reasons when it comes to energy markets will be a really important shaping factor. And the extra 2 I added to your list of 3 also come prospectively at some cost of transition. Now, there's a question about how much of that cost is borne by government and how much of it is borne by the private sector. Let's take just one of your Ds, maybe 2 of them. Let's take digitisation and defence. On digitisation, I think the heavy lifting will have to come from the private sector, rightly will come from the private sector. And indeed, that's what we're seeing so far on the AI front, that the driver of that is not governments. It very much is the private sector, and it's vast amounts. The 4 big US hyperscalers, I think they invested something like $300 billion in AI alone last year. Absolutely off the charts. On defence, obviously that is a national security falls ultimately to governments. But I think they will sorely need the assistance of the private sector, of the big defence primes and the accompanying supply chains to get close to meeting our national security needs. It will require that innovation drive to rise to tomorrow's security challenges, and that innovation drive may well be part financed from government, but will need to be led, I think, by the private sector, as it has been in the past. So I think those 3 or those 5 will be the key contours. And the trick for government will be to turn the challenge of them into opportunities. Defence is a necessity, but it can be turned into an opportunity if you use it to drive innovation and jobs. Digitisation is pregnant with potential to transform our levels of productivity. Decarbonisation or the net zero agenda can be used as a springboard to greater investment, lower energy costs, and therefore improved productivity. Demography, if we change our model of working and work for longer in a productive, healthy fashion, that can yield a dividend for GDP rather than coming at a great cost. So I think the interesting thing about those megatrends is that it's very easy to slip into thinking that they are the challenges of our time, and they are. But they are, at the same time, the opportunities of our lifetime. And putting the second of those mindsets in place, I think, is really important for us.
You're reframing. That's what a lot of
trying to.
That's a good way of thinking about it. I mean, the one that excites me quite a lot is the digitalization one, because if I look at those 5 Ds now, I mean, the demography versus digitalization, I think, is quite interesting for the UK because not only do we have an issue around an aging population, but also across, I think, most advanced economies, there seems to be an aversion to immigration. So that channel of transmission should not be taken for granted, as in the same way in the past, which then means that your demographic challenges, are heightened even more. Which then brings into play digitalization, which, I mean, we don't exactly know how it will pan out, but there certainly is a quite increasingly more compelling case and evidence of digitalization working together with labor to produce output which is more, of high use, high quality in a shorter period of time. And it also seems to be much more applicable in the services sector, which is an area, I mean, that's the majority of our economy. So then I would have thought that there is a bit more of a potential there, particularly for the UK, to harness that value and even being a bit of a leader in that, in the application of digitalization.
Yes, well, I hope so too.
Yeah.
I mentioned before that sort of league table of AI investment spend, where US companies are way ahead, right? So US top of the pops by miles, 300 billion spent last year, dollars. Next was China, about 13. Third UK, about 6. And then a long tail of others at similar sorts of levels. So the starting point for the UK is positive, third in the global league table, but with others nipping at our heels. It wouldn't take very much for us to slip from third to outside the top 10. We have some natural endowments, which should give us a degree of optimism. Our fantastic universities are a huge trump card to have. We do very well at spawning innovative businesses as well. But I think now is absolutely not the time to rest on our laurels, because such is the speed of change and adoption that you probably find yourself slipping from being in the top 3 to being outside the top 10 in the space of 12 months, unless you keep pushing as businesses and as governments.
Yeah. And also, I think there might be a point there around, particularly for the ones that are lower on the league table in terms of pooling resources in the future.
Yes.
Just to be able to compete and also take into account the classic economies of scale that are relevant and required for this endeavor. Okay, maybe we should wrap this up by potentially taking some of the points that we mentioned about what this could mean for the UK government and maybe the priorities of the UK government in the future. Because the backdrop, the international backdrop, is changing in ways that we either didn't predict 2 or 3 years ago, and also at a pace that's quite fast. So any thoughts on that?
Well, I mean, even since our previous podcast, domestic matters UK have changed quite a lot. We will now have a change of Prime Minister, most likely Andy Burnham, and that's will happen very quickly, actually, in the space of a month, really. And as with any new leaders, and most likely some new members of cabinet, there's a chance of something of a policy reset. Speaking to the challenges that you mentioned just now, Barrett, defence is one of them.
Yeah.
So an agreement has been made on a defence investment plan, albeit belatedly. The question for the incoming team will be, is that big enough? It falls well short of the NATO 3.5% of GDP target. Will that be big enough to meet our NATO needs, our national security needs? And will it be large enough also to serve as an engine of job creation and innovation, which I think we should see the defence step up as an opportunity as well as a threat, an opportunity to create jobs and to nurture innovation and business. And mentioning business, I think among the most important things for the incoming team to do is to also achieve something of a reset with business. There has been, for a number of years now, it predates this government actually, a fearfulness among business about what might be coming down the pipe, particularly by way of tax rises or extra regulation. Yeah. And that fearfulness has had to come at a real cost. Yeah. Because if you're fearful of those things or fearful of demand not being there tomorrow, you tend to stick rather than twist. You tend to save rather than put your balance sheet to work. And that's among the reasons why business investment has been so sluggish and the economy has been so sluggish. So here's an opportunity to reset the dial with business, to, for a new team to put to bed once and for all that fearfulness about what might be coming down the pipe, whether it's tax rises or increased regulation. We did a piece of work with the British Chambers of Commerce, where I have a role, as you know, Barrett, just looking at the cost base of businesses and how it had been added to by government actions over the last 10 years. And the punchline from that piece of work, very detailed piece of empirical work, was that the average business has seen its costs increase by 70%, wow, more than over the last decade, and by 15% over the last 2 years of this government. So completely understandable that businesses are feeling the pinch, yeah, and feeling their margins squeezed and are wanting that burden to be added to. I think an incoming team could do a really positive thing for animal spirits, for business sentiment, if they could reduce fearfulness of that cost envelope being pushed even further outwards in the year ahead. So those would be some of my, hopes from what looks likely to be a reset in at least personnel.
And we did say, I think it was the previous podcast where we talked about how not stretched the balance sheet of the UK private sector is. Debt levels in the UK economy, in the non-financial sector at least, yes, are at 21st century lows, yes, relatively speaking.
That's right. That's right.
Which then, points out to the fact that if you've got a predictable, stable regulatory environment, and if you've got certainty about the tax landscape for the next few quarters, then animal spirits could and should be activated, which could then actually lead to that positive sort of escape velocity that we're after, which is businesses investing, creating jobs, and then output increasing. And that's what we're seeing across most advanced economies. It's this interesting concept I call domestic growth. So the US has always had that large domestic market and hasn't really traded that much with the rest of the world. So you're seeing that approach being adopted in Canada with Mark Carney's approach on ensuring that regulations are the same across provinces and unleashing some growth. You're sort of seeing something along the same lines in the Eurozone and in the EU. I think we need to find our own sort of sources of domestic growth. I think housing is one of the ones. Yeah. Defense could be the other lever. Yeah. But there are quite a few levers you can pull as long as there's a stable, predictable environment that doesn't add to the cost of businesses. Because as you said, I think in the past few years, those costs have been potentially disproportionate.
Yeah. They've certainly been very significant, and they've come at a real cost in terms of businesses' willingness to put their healthy balance sheets, by and large, to work. And that always has been the engine of growth. It always will be the engine of growth. And here's a chance to refire that engine of growth, I think, if the right words are uttered early on about achieving that stability and certainty.
Well, with that positive message, I think we should stop it there. Thank you very much, Andy.
Thank you, Barrett.
And thank you for listening to us, and look forward to seeing you next time.